I'm really, really excited to introduce our next panel, which will be led by my esteemed colleague, David Yermak, who's the head of the finance department here at NYU Stern, and who did some of the pioneering research on blockchain and Bitcoin. So let me hand it over to you, David.
Thank you very much. Okay, good morning. We have 3 speakers in the panel this morning. And in addition to me, Yanis Bacchus and Katya Malinova. The first speaker was intended to be my colleague, Sabrina Howell. Sabrina had a baby 1 week ago. And we knew that this would happen, but we're not entirely sure when. But since it was last Friday, she won't be speaking today. The paper, and I don't think we have the right topic here, but the paper is co-authored by me, so I will stand in for her. Okay, so I'll be speaking about a paper I've co-authored with Sabrina and Marina Niesner from Yale on initial coin offerings. And I want to begin by speaking about the Token Summit that was held in May of 2017, about a year and a half ago, and it actually took place right in this room. The people who ran this had no connection with the university, but sort of acted like they did. They rented a room, they put the university's name up. They tried very hard to get faculty to come speak at this, including both Sabrina and me, and to a person we all refused because we thought that these tokens were completely fraudulent. Up until that point, there had been crypto assets that were mined, assets that were airdropped, that were created through a variety of ways, but this was really something new to just create these and sell them directly to the public. This is one of the few things I regret in my career, not taking part in the Token Summit, because not only did this turn out to be very real, but it was the point of departure, and we can look here at the monthly data, that if you pick up the story in May of 2017, that was really the first month that you saw crypto sales of what we now call ICOs, of any real volume. These grew exponentially through the end of the year to the point that about $6 billion was raised. And now in the first 9 months of 2018, there's been triple that, more than triple, 20 billion raised. And a couple of big spikes representing some very large offerings that closed at different points in time. So we have an innovation here that has very quickly gotten traction in the markets. And it is beginning to look like a substitute or successor to venture capital. The worldwide venture capital industry in its entirety is about 150 billion. And when you've raised 20 billion year to date in ICOs that tend to be focused really on a few industries, you see that venture capital is giving way to this as a new type of fundraising for entrepreneurs. And the design of these things is really quite interesting, and this is really what I wish to speak about in my time this morning. So here's a ranking of the largest ICOs to date. And the amounts of capital being raised by entrepreneurs is just very, very impressive. You never see initial public offerings raise this much money unless it's something like Conoco or a very well-established company. But it's now possible for entrepreneurs to raise money in the hundreds of millions of dollars. And typically, these are quite liquid in that the people who invest in them are able to turn around and sell them sometimes right away or often after very short vesting periods, which is quite different than traditional venture capital, which tends to be locked up for years. Now, the tokens have clear antecedents, I think, in 3 different ways. They resemble in many ways social media tokens, and I think the most successful of these up to now has been the QQ coin that was successfully launched in China a few years ago by Tencent. They also resemble in many ways video game tokens. So there is a whole parallel universe where probably none of you, but your kids may spend a lot of time here playing fantasy games that have their own internal economies where you can win coins, but most importantly, trade these coins. So there are now investment platforms such as this thing called MMO Bucks, where external to the game, you can win virtual money and then speculate in it and trade it with other people and so forth. One of these was acquired a few years ago by Goldman Sachs, who knows a lot about foreign exchange and didn't see too many differences in how you would run this market versus a Forex market. I think the closest analog to these, though, is in the world of professional sports. This is the giant stadium that is in the Meadowlands not very far from here. And when it was built a few years ago, several $100 million was raised by individually selling the seats through a device that's called a personal seat license. And about half the teams in the NFL have done this in recent years. And what you're buying is the right to be a customer for a platform, in this case a sports stadium, where there is a clear limit on the capacity, the number of people who can go to the game, for instance. And you have the right to trade those seats in a secondary market, which is what's on the right, this thing called PSL Source. And what the team is doing is really capitalizing the value of future consumer surplus. In other words, you're raising money from your customers, and they're willing to invest in this on the proposition that the enjoyment for being a customer into the future is basically worth more than the team is charging. And I think in sports in particular, this solves a problem where you can't jack up ticket prices if the team makes the playoffs without risking public blowback and condemnation in the press. But if you can quietly sell this as a capital asset in advance to speculators, it's probably a way for the team to raise capital at a much lower cost than going to a bank and so forth. So I think what ICOs are doing are using a very similar model. They are raising money from future customers, and they're using smart contracts to put a cap on the number of tokens, the number of customers, in a sense, who will be able to use the platform in the future. So we've traced this back in history, and skipping a few steps, such as Wimbledon and the Sydney Olympics, the earliest example we found is Royal Albert Hall, which about 150 years ago was built with the same model, with creating a scarce allocation of seats to future customers, and then selling the right to be a customer in perpetuity to people who still today are trading these in a secondary market 150 years later. Apparently, there are even medieval churches in Germany that have used this business model. I don't know if you can resell the pews. But I think the innovation here is very interesting in the capital markets, that you're raising money not from debt and equity, but from future customers. But like many things in finance, it turns out it was probably invented by the British 200 or 300 years ago. Now, in our study, we look at a sample of 453 ICOs, and we require you not only to have successfully raised money, but to have traded for at least 90 days in the secondary market. So unapologetically, we are looking at the top of the distribution, the people who have raised most of the capital and gotten most of the attention. So this is quarterly data about investment in blockchain startups. And you see venture capital almost exclusively, which is the red bar, up until 2016, when ICOs begin to peak out. The total raised each quarter in light blue is the uptake of ICOs, but it's really in the second quarter of last year, right after that token summit in this room, that this market just exploded. So with the 90-day trading exclusion, we don't capture every one of these, but we get the large majority. So the dark blue is the amount of capital represented in our sample. It begins to tail off at the end of the sample period simply because we cut off the data collection at a certain date. But if we ran the study forward, we would sweep in all of those as well. So some of the data that gives you a sense of what the market looks like, many of these ICOs are actually split into two pieces, where they have the public auction, but not until there's been a pre-sale where selected customers, who are sometimes called the Bitcoin whales, these tend to be well-known venture capital investors, but they will get often a preferential price and agree to somewhat different conditions than the public is able to participate at. So this happens about 45% of the time. And 34%, about 1 in 3, have what is called dynamic pricing in the auctions, meaning that the price changes constantly based either on what price people were paying a minute ago, or the total volume raised, or really any function that you wish to use. This is completely unregulated. So you can do things in this market that you cannot do in a US sale of securities in the regular markets. It's quite interesting to see what people do. It's almost like an experiment, like what if you had abolished the securities laws, what would people do instead? Mostly these are sold for other crypto, and they add to more than 100% because you sometimes have a choice of Ether, Bitcoin. Relatively few accept real money, such as US dollars, which is taken about 10% of the time. I think our most interesting results are connected to the disclosure that these coin issuers are doing. There is great fear on the part of regulators that essentially these will exist without consumer protection and that you won't benefit from the disclosure that you would get in a typical securities offering. On the other hand, we've had an intellectual argument going back really to 1933 and 1934 that the securities laws may be not only unneeded but even overkill. That if you had a world of just voluntary disclosure, first, people would disclose because it's in their interest to communicate with investors, and you would get a greater diversity of disclosure that is much more closely connected to each individual company based on its industry and ownership and economics and so forth. And we find exactly that. The first thing to note is that there's just a huge amount of disclosure. Almost everybody in our sample communicates with the market, and the variety of channels is quite rich. There's a lot of social media, Twitter and Telegram. About 81%, 4 out of 5, file what they call white papers that look a lot like a prospectus, but the white papers disclose individually quite a bit of different information for each one. And some of the most interesting disclosure is to post the code underlying the token itself. Typically, these are smart contracts on Ethereum. And to simply post the code on GitHub, in terms of due diligence for an investor, there's really no substitute for actually reading the code if you're going to buy a crypto asset. So this is probably something that the SEC would not require if it were regulating this market. You know, this is really quite different. And we were struck not only by the detail of the disclosure, but the analysis that we do. These are regression results that we are studying in terms of the aftermarket liquidity as a measure of the success of the tokens. It's closely connected to whether you have a white paper, whether you post the code on GitHub, and also to more traditional economic methods like do you have vesting schedules for the insiders, in that if they have an allocation of tokens, and they usually do, are they restricted from selling them into the market, at least for a period of time? So I think the closer you look at this market, first of all, it seems to be extremely rational, that if you take steps to reassure the public and give guarantees of your own commitment to the success, that clearly is reflected in the aftermarket liquidity and your ability to attract investors. And arguably, there's more disclosure going on that's more informative here than you get in the IPOs of equity securities, which we were really struck by. So the idea that this market may be fraudulent and risky, I think every market has its own baseline of fraud and risk, but in many ways this looks quite compelling as a way to raise capital and very interesting for investors to participate in. So 2 other quick results. We looked at the background of the founders themselves. We read LinkedIn for several hundred coin issuers. Turned out 97% were male, which is the biggest gender gap I have ever seen in any kind of finance study. And you know, even CEOs of public companies and so forth don't skew quite this extreme. But the ones who are best at launching these tokens are the ones who are already successful entrepreneurs. A good example is the Brave browser, where the people who brought Netscape to the market many years ago are also behind this browser. And it's much better to have entrepreneurship experience than to have experience in finance or cryptography or computer science, at least in terms of the response of investors. And we find that the most successful tokens are the ones that are the so-called utility tokens. So these are not simply the securitization of other assets, such as Tether or some of the gold tokens that you're seeing. These are tokens that are really focused on customers getting access to a scarce platform. And I think in informing the debate where the SEC is obsessed with regulating these as securities and saying that they are not anything other than speculative instruments in disguise, you would point to a result like this, where it's really the utility value of the token seems to be what is attracting the speculators and the investors. So the conclusion here is that really something quite interesting is going on. And I think against all expectations, this market is continuing to thrive. It is a very innovative and new way to raise capital. And I think it's something that is likely to be with us, well into the future and is going to demand integration into the fabric of the capital markets sooner rather than later. So thank you very much. And I will now move to the next paper. Okay, so the second paper will be presented by my colleague Yanis Bacchus, and if you would. Thank you.
Thank you very much, David. What I want to talk about is about a particular application of this fascinating new world that David described. And David showed a slide in the beginning where he had the 10 most successful tokens. And if I counted, about 6 or 7 of them were platforms. And as he mentioned, one of the most successful applications of tokens is issuing them by platforms that typically are new platforms that are trying to establish themselves. So what I will talk about is some work that looks at how platforms can use tokens as a way to promote adoption. And this is joint work with my colleague, Hannah Calaburda. And I have some motivation, but you got a whole 15 minutes of much better explanation for how this environment has become popular, the exponential growth that we have. One possibility is what we're seeing a lot of hype. One possibility is the reason why IPOs are so successful is that they give you the opportunity to do things without following all of the regulations. There's a possibility we have a big bubble. But if that is the case, at some point, this is going to deflate. And then the question becomes, how much real value do we have? Can ICOs, can tokens help companies create value that they couldn't create otherwise? And so the work that we'll talk about is in this stream of research, and in particular in the context of a platform. Now, platforms create value by bringing together many different types of users. It could be friends on Facebook. It could be borrowers and lenders in the lending club. It could be drivers and riders in Uber. The key thing here is that typically platforms have very strong network effects, which means that platforms become much more valuable as they can attract more participants. I mean, obviously, I don't want to be in Facebook unless my friends are in Facebook. And once my friends are in Facebook, then Facebook becomes much more valuable to me. And this network effect is something that economists have studied for decades. And one of the results that is very common when you look in the literature and you analyze platforms is what we call the coordination problem. It's essentially the chicken and egg problem. It's the challenge in bootstrapping the platform. The fact that nobody wants to be on the platform unless everybody else is on the platform means that the platform can have a problem when it is a new platform in trying to establish itself. And this is actually especially true if there is a cost in joining the platform. If you must incur a cost in joining the platform, you are not going to do it unless you believe that the platform is successful. Now, typically, the way platforms solve this problem is by subsidizing early users. Like, I've been around long enough to have received $20 to open a PayPal account, plus $10 for every colleague or every friend that I recommended to PayPal. That was quite expensive for PayPal. I think I ended up getting about $150 to $200 to, back in 2001 or 1999. I never got an incentive from Uber, but I did get a month of 30% off from Lyft and a whole bunch of free rides. And this is typical. As a platform, you want to offer incentives to the users. And what you do is this way you establish yourself and you make money from the later users that come in the platform as part of the second wave. Subsidies require capital. And capital may be available to companies like Uber, and it was available back in, for PayPal back in 1999. But for a lot of new platforms, it may be difficult to raise capital and offer subsidies, and especially if they're perceived as being risky. And what we find and what the question we address is whether platforms can actually use tokens and an ICO as a way to incentivize users to converge on the platform, and therefore as a way to make the platform successful. Because a lot of the strategies in platform is trying to establish yourself as a self-fulfilling prophecy that you are the place where everybody will converge. So if you can convince your users that you're successful, you become successful. So can you actually get your users to join you by giving them a token instead of a subsidy? And when would you want to do that? And we find that this is actually true, that if you issue tokens, this allows you to either reduce the subsidy that is necessary, or even better, instead of subsidizing your users, you can make money from them, and you can essentially make it a lot easier to finance the development and the establishment of the platform. Now, depending on what is your cost of capital, tokens could be a lot more attractive than other alternatives, because your other alternatives are typically either raising VC funding, basically issuing equity, and more rarely, you can maybe access the debt markets and get debt. So depending on what is your cost of capital, it could be the tokens are the way to go. And not surprisingly, this is especially true when your cost of capital is high. When your cost of capital is moderate or low, actually it turns out you could make more money in the long run by issuing subsidies or by attracting your users rather than giving them tokens. And the reason for that is that when you issue tokens, essentially what you're doing is you are, especially in the case of utility tokens, which is typical in what a platform would do, is essentially you are pre-selling your future services, and you need to compensate the users for the fact that they are taking a risk. So you will typically need, the more risky you are, the more you will need to compensate your users. And in effect, what you are doing is you are giving up future benefits, future profits for the return that you're going to get up front, which will allow you to create the platform and launch the platform. And we do this with some economic modeling. We study this question. And we have a two-period model so that we can capture the dynamics of the early adopters and the second wave of later adopters. And so we have a platform. We look at early users and late users. And we have a situation where we have a coordination problem in both periods, which basically means that we're looking at a situation where most of the value from the platform comes from the network of other users, and therefore the platform is not going to be able to convince those users to join unless everybody believes that everybody else will join, or alternatively, unless the users are bribed or subsidized in order to join. So first period, users arrive. We compare two possibilities. One possibility is that the platform subsidizes or sets a price for users, and this could be a negative price, which is what you would do if you're offering a subsidy. Almost always, what happens in these cases is your early price is discounted. That's how you get your users to join, and you hope to make up the discount from the later users. Once you've established yourself, you'll be able to raise your price. And as I said, this discount could actually mean that you go below zero, you pay your users as Uber or PayPal were doing in the beginning. The other possibility is that the platform sells tokens. So you do an ICO, and you let users buy your token. And then what you hope is users have an incentive to make the platform successful. They're going to converge on the platform because the tokens will have more value in the future if the platform is successful. And you can see what happens in the first period. And then you have the second period where the second wave of adopters come in. Some of the users from the first period will leave, and what these users will do, they will trade their tokens to the new arrivals. And depending on the setting we study, either the platform now has a new price for the second period. In the second period, your price will never be negative, so you will always try to make money, and you will make, again, as much money as you can, depending on how successful the platform was in the first period, and depending on how much it can convince the new users that it will succeed in the second period as well. The other possibility is that the platform still sells tokens. It sells tokens to the new arrivals, or anybody that arrived in the first period and didn't buy a token, they can buy a token in the second period. So this is the setting that we study. And again, let me repeat that a key feature, of course, is that users that bought a token in the first period, they always have the option of trading the token and essentially realizing a return in the second period, because token prices will go up if the platform is successful. So what we find is by issuing tokens, the platform can make more money in the first period. So when the platform tries to launch itself, it needs to offer lower subsidies, and actually it can make money by selling its tokens, essentially by pre-selling the future services. And the reason this works is that users that buy the early token, they know that their token, or they expect the token to appreciate, and so in a way they're investing in the success of the platform. So you can think of them that even though this is a utility token, there is a little bit of an equity component in the sense that the users become vested in the success of the platform, where the return is not going to be a formal appreciation of equity, but it is going to be an appreciation of the utility token. Without the token, the platform needs to subsidize users in the first period, which means that you need to spend more money in the first period, but you make it up in the second period. It turns out that once you are successful, you don't need to compete with users that have bought tokens in the first period. You can enjoy the full value of your success. You can price, basically, and extract as much value as you can. So our first result is that the second period effect actually outweighs the first period effect, which means that if you face no cost of capital, if you can do either, and it won't cost you more to subsidize users in the first period, you make more money by offering a subsidy. Hold off on the token. However, if you have a high cost of capital, or if capital is not available to you, as it is not available to a lot of these aspiring platforms, then you make more money by issuing tokens. And the best strategy that you can follow is to issue tokens in the first period and then also issue tokens later. And it turns out, actually, that the token strategy is more attractive, in a way, the more risky you are. So the less you can establish yourself as being inevitable, the more you want to issue tokens. And that makes sense, because if you can establish yourself as being the inevitable winner, then users basically are pretty sure that you will actually succeed, and they don't perceive you as risky, and you can raise capital. But if you're a risky platform up front, then it turns out that, again, users will need a big subsidy in order to decide to adopt you. And in that case, you may be better off by issuing tokens. And by the way, I've been telling you a story. We do have a model with a lot of Greek letters and diagrams. I'm not going to bother you with that. But to conclude, I will summarize what we find. Again, tokens provide a mechanism for a platform to incentivize users to adopt it. And a key aspect here is the fact that tokens are tradable. The fact that early users that they buy the tokens can trade them later and participate in the success of the platform. if you have an option to do either, what happens with tokens is you get more money early, but in some ways you're giving up future sales. You're selling your future at a discount. So in some situations, if you have low cost of capital, it would make sense to subsidize the early adopters. But if your cost of capital is high, then you don't want to offer subsidies, you just give them cheap tokens. And the key actually finding out of this is that for a platform that is facing a high cost of capital, it would not be able perhaps to establish itself without tokens. So what tokens enable, they enable the creation of platforms that could not be sustainable without them. So in that sense, they do what economists call create more economic surplus. And that's why we think the whole token ecosystem can actually create a lot of value, and it's a very interesting innovation that we are staying on top of and we keep studying. So I will stop here. Thank you very much.
Okay, thank you, Yanis. I'm surprised to hear you didn't get the Uber discount. And I'll invite you. I think everyone else in the room.
I started using Uber way too early to get the discount.
Talk to me afterwards, because I can still get you in. Oh. Okay, our third presentation will be by Katya Malinova of the University of Toronto, and the title is Market Design with Blockchain Technology.
Thank you, David. Thank you, the organizers, for having me. I should say that I have moved to the Groot School of Business at McMaster, but indeed I'm still on leave from the University of Toronto, and my colleague, Andreas Park, is at the University of Toronto. So as David, as Yanis talked about, blockchain-based trading is now a reality. And the question that we ask in this paper is, what's the impact of blockchain design on blockchain-traded assets, on trading blockchain-based assets? And coming at it from my research in market structure, my main question was, well, what's different about trading blockchain-based assets from the trading perspective, not the valuation or investment perspective? And one of them is that multiple trading protocols are now possible. You can still trade them in a limit order book, or you can trade them peer-to-peer. And peer-to-peer here differs from the over-the-counter markets that many of us are used to, when there is a dealer and an intermediary involved, and I cannot just go and find you. With tokens, I can go and trade with any of you right away, and I can find you right away as well. So we don't have to go through the brokerage to do this. The second feature is that by default, this trading is extremely transparent. If you go on Etherscan, you could actually see the addresses for any transaction that traded with each other. So you might be able to identify frequent traders, and you will see the IDs that trade frequently. And it's not just the transactions, but you can also aggregate these trades and see the holdings. So you can sort of see the whales, or traders that trade a lot, or rather hold large positions. And so this brought us to two answers to our original question, what's different? Well, first, we get frictionless peer-to-peer trading. And this is, of course, the nature of blockchain technology. Like internet allowed us to transfer information. Now we could transfer ownership, including ownership of contracts. And the second is that the informational environment for trading these assets, securities, tokens, utility tokens, is dramatically different from that we know from equity markets or bond markets or any securities markets. Of course, here there is one distinction that when I say wallets or addresses, they're not the same as traders. And again, this would be a difference to traditional over-the-counter market, where you probably would know the counterparty that you're trading with. And that brought us to the question that we tried to address in this research paper, and it's a theoretical paper. How does the design of the technology, how does the design of the ledger transparency and the usage of the identifiers with possible peer-to-peer interaction, how does that affect trading behavior? And how does that affect economic outcomes? And we're agnostic in this paper as to whether we think this is a utility token or a security token. But it's probably what we had in mind when writing it as security token more so than a utility token, so that you actually trade it frequently and not just I sold it to you and I'm done. There is now a lot of literature on the topic that I will skip in the interest of time, including by people in this room. And in terms of the model, again, as I said, it's a theoretical model, and it's a trading-based theoretical model. So we have a risky asset. We're going to have two large investors. One is going to be hit by liquidity shock, so they have to trade. And the other has a possibility of absorbing this shock or trading at zero cost. And we have some small traders that are distributed, so the peers that you could also trade with, again, differently to the over-counter market. And we have an intermediary that you're able to trade with, but the intermediary is risk averse. And so every time you go to the intermediary, it's an inefficient transfer of risk, and also you pay the cost to the intermediary. So the question that we have is, well, how do the costs compare? Well, there are direct costs for trading, and when we're assuming in the paper that it's quite costly for you to trade with small investors, small traders as a trader. And the reason for that is we say data processing, but it doesn't just have to be data processing. For me to trade with you with so many platforms, and for me to find you, I have to actually go, and because there is no broker, I can't just hold an account at a brokerage and trade on multiple different platforms. I actually have to go and open an account on every single one of these platforms for me to trade with you. And that's costly. It includes also capital transfer often. And just generally, when I trade and I have many transactions, you could also think of this as a transaction cost, because the more transactions I have, the larger the validation costs that I have, the mining costs. So it's a cost per transaction, not so much per value. And if I'm trading with a large trader, there is also an indirect cost, because the person may front run me by going to the intermediary and raising the price. And so when we're thinking about it, we're thinking of three different possibilities of sort of designing the addresses or designing the blockchain. So one is our benchmark. When we presume that everything is transparent, so as I showed you on Etherscan, you can see the address that you're trading with, and you can see all the past transactions. And however, I can't just go and generate multiple such addresses. And why can't I? And one is because as a private blockchain designer, you decided to prevent me, and you do the KYC, know your customer, and you say, that's it, you're allocated just a single address. Another possibility, as a contract designer, token designer, you decided that you're going to restrict who is able to trade your contracts. Why would you do that? Well, one example why you might want to do this is if you want to restrict trading your tokens just to accredited investors. You'd need to know which addresses, which wallets these accredited investors have. So there is a possibility outside of the public blockchain and outside of trading Bitcoin and Ether that you are able to actually restrict trading. So in the benchmark model, again, everybody knows and sees everything. We're not restricting transparency, just the number of IDs. And the options for the large trader are two. You can trade with small investors, or you can trade with a large one. If you trade with the small ones, you have this complexity costs. If you trade with the large ones, they might front run you. And if we only trade once, then actually I wouldn't trade with a large investor. Because if we only trade once, they are going to front run me, and they're going to extract the entire surplus. I'm not going to get anything from it. However, if we trade repeatedly, because we're large traders and we know today you'll front run me, tomorrow I'll come back to you and I'll want to trade with you again. Or you may have to trade and you'll have to come and trade with me. And I won't because you front run me today. So in theoretical terms, we're modeling it as a repeated game, and you're punished by the grim trigger strategy. So there is a theory to that. But the bottom line is, when we interact repeatedly, social norms are gonna start to work. and the large traders will trade with each other. So we will avoid trading with an intermediary. We will avoid the inefficient risk transfer to the intermediary. We will avoid paying the extra cost. So this model is, the benchmark model is actually best for welfare pretty much by design. However, we recognize that people may want to hide their trading intentions, and they may want to hide their IDs. And one way to do it is just to say, we have the same model, but we don't show you who trades. We don't show you the IDs. Well, in this case, because I don't know which of you is a large trader, if I just randomly approach some of you, chances are I'm not going to find the large trader. So in Equilibrium, I trade with small investors, and I trade with an intermediary as a large trader. And turns out this is the most inefficient setting. So if you wanted to restrict transparency, that shouldn't be the way to go. Because this, even though it seems very natural that you just take a normal setting, a regular setting, and you put a privacy screen, the problem is that that disallows the large investors to find each other. And that creates problems for liquidity. And if it creates problems for liquidity, that's going to create problems for welfare as well. So another way to think of achieving privacy is what was suggested by Vitalik Buterin when discussing Ethereum, is just allow people to create as many addresses as they want and try to hide by creating multiple addresses. I'm not talking whether it's technologically possible, but even if you were to just put a privacy screen, still you should be thinking of putting multiple addresses. So in this case, if you have multiple addresses, a lot of the results in our paper depend on the probabilities of acceptance and the probability that if I come to trade with you, what are the chances that I'm going to find a counterparty? The problem with putting a privacy screen in a single ID is I cannot find that counterparty. Now, when I allow you to have multiple IDs, large traders, multiple IDs, I'm much more likely to find that large trader. And whether or not it's beneficial or not is going to depend on whether or not that large trader trades with me or not. Now, as I'm almost out of time, I'm going to skip the technical details, except that they're not getting skipped. And I'm going to proceed with a couple observations. One is that when we have an intermediary, every time we have an intermediary, the market is potentially socially inefficient. When we have large traders interact with small investors peer-to-peer, that's going to impose transaction costs on large investors. So what we would like to do is we would like to design a system that would ensure that our large traders are able to find and trade with large traders. And if we're comparing the opaque designs, for this reason, when we have a privacy screen with a single ID restriction that large traders can just have a single ID, that's going to be welfare reducing. And in the system when the large traders don't interact, it doesn't really matter. But another comment that I'd like to make is often in our model, in order to prevent large traders from front running, I'd have to pay concession to the large trader. To say, well, if we interact infrequently, you don't know when you're going to get hit by liquidity shock, so I'll pay you today a little bit extra, still less than to the intermediary, to prevent you from front running. Well, in a system with multiple IDs, because I don't know who the large one is, I'm going to have to pay this concession not just to the large trader, but also to the IDs of the small traders. And so there are configurations when welfare efficient is to do one thing and large traders are going to prefer something else. So in summary, back office designs do have front office, do have trading implications. We should think about it carefully. And what our model tells us that the public solution to privacy might actually be the most efficient one. Thank you very much.